Welcome everyone to the webinar. Thanks for joining. As Matt said, today we're going to focus on how to think about valuing early stage businesses and how to present those valuations to investors and some related topics that we encounter when negotiating and looking at very early stage funding rounds. Let's do the introductions first. So if we start off with Mark Allcroft, KPMG.
Hey, thanks, Mark. There's gonna be far too many Marks, isn't there, on this call? It's great to be virtually here. Lovely to meet you all and great to be involved. So, my name is Mark. As Mark said, I lead KPMG's UK deal advisory business, and I specialise or spend all my time in the technology, media, and entertainment sector. I have a passive interest in telco, but I've got other people who look at that because it's a little bit far too technical for me. So I spend a lot of time media, entertainment, and technology. What do I do for my day job? I help people buy and sell businesses. So I've been doing this for about 22 years. I'm a due diligence partner, so I spend my life, analysing businesses, understanding what their equity stories are. Does the evidence underpin what management are telling us? Does the valuation stack up? And what do I think to the business plan given the opportunity looking ahead? So spend a lot of time with large corporates, private equity, but everything from kind of early stage startup through our Acceleris business and through our kind of emerging giants business, right through to sort of mega cap transactions. So hopefully that experience is relevant for this discussion. So great to be here and look forward to the discussion.
Great. And Pukar?
Hopefully you can all hear us in the room. We had a bit of a tech glitch just for a second. So my name's Pukar, and I'm very, very grateful to be asked to join this discussion. So thank you. My role at KPMG, and I've only been here for 3 months now, is I run the media strategy team, so helping media clients go through deal strategy from pre-deal, during deal advice, and post-deal value creation work. My background, I spent 10 years in management consultant and venture capital in my first part of my career, and then spent 15 years at ITV. And my time at in consulting beforehand and at ITV was really driven around acquisitions. So supporting companies through their acquisitions as a consultant, and then being a principal on a number of deals at ITV. And I think it was about 23 acquisitions and investments at ITV, but I probably looked at about 400 others. As well as my role at KPMG, I'm on the board of the National Film and Television School, and I'm chair of its creative business faculty, which is now being rebranded. I think it's called Business or Creative Industries now. And as part of that, I do the Dragon's Den session where their students who come through the master's program are then pitching ideas that they ultimately want investment for. And I'll do that kind of pre-rehearsal bit before they have to do it as a dissertation, before they actually get to pitch to actual investors. So I've been in a number of these kind of very, very early stage idea pitches quite recently.
Great, thanks. And I'm Mark S. I'm a partner with Russells. Russells is a London law firm. We work almost exclusively in the entertainment industry, and we're best known for our music industry work. Within music, we act for the full range of players, from traditional music businesses like labels and publishers and managers, through to artists, through to investors in music rights and companies, and music tech startups in various areas that interact with music or the music industry. And we love working with Matt and MT UK because MT UK brings together lots of those strands in a way which is very interesting to us and where we think we can add value. I'm a partner in the corporate team, so I focus on advising companies and investors on corporate transactions, including helping startups, venture capital and private equity investments, and then buying and selling companies, corporate advisory work in the same way as Pukar was saying. Before I joined Russells, I worked for big European and US law firms in the city for a long time, doing venture, private equity and M&A. It's a long story, but the short version is that I joined Russells to focus all that corporate experience in the areas that I loved working in the most, which is the music industry, generally including music tech and founders that are working to build businesses. So to go back to the topic for today, the reason that we chose this as the first webinar in the series that Matt described is that when we as lawyers start talking about early stage investment with MT UK's music tech members, we often get asked questions about valuation. And so starting with how should we value a very early stage or a pre-revenue business or even just an idea? And then off that, how should we seek to raise money in very early funding rounds? And then other questions like how much of the company's equity do you think we should make available to investors? And we felt that these questions deserved a session focused very much on those. Because to be honest, lawyers can't really answer those questions. So, some lawyers will try, but I've always believed that lawyers should be lawyers. And there are far greater experts out there on these areas, like KPMG, the team that are here today. So before we get into it, I just wanted to emphasize quickly that this is not supposed to be a kind of technical discussion of detailed valuation methodologies. Maybe that's another time. It's starting from the beginning, really, from an assumption that people in the room here are running or working at or developing pretty early stage businesses. Some might have raised money, some of you might not yet. You might not have actually launched the business, maybe working on an idea. Some people may know a lot of this, but I hope there'll still be some interesting and useful things here. As Matt said, we plan to approach it as a discussion, so do feel free to interrupt and ask questions as we go through. The plan is to finish by 2, but feel free to interrupt us. That's fine. So I think, Pekar, to start from the very beginning, before even thinking about valuation, as a person looking at a business, what do you most want to understand about that business and what it's trying to do?
Sure, it's the valuation comes a little bit down the journey when I first meet startup businesses. First of all, you want a really interesting and compelling proposition. So what does that mean? That means the founders, the management team have identified a real sort of opportunity in the marketplace, whether it's a service or product that's not currently being offered, or it's a way of doing that service or product better, more efficiently, or actually disaggregating or disintermediating the industry that it's targeting. So it's about having a compelling proposition, and that proposition won't be equally interesting to lots of different potential investors. It will be interesting to some because it hits their potential sort of focal areas or kind of size of opportunity, and it'll be equally sort of less interesting to others. So it's also about finding the right conversation to have, and you might have to have a lot of those conversations before you find the right one. But once you've got that proposition, it's about trying to work out how best to communicate that in a succinct way as possible. And lots of people use slides, you might want to use a video, you might want to use lots of different methods. But if you can work out how to deliver that message of what the unique proposition is that you're solving in 30 seconds, that is your elevator pitch, and you should have that ready to go at any point in time. Ultimately, then, what is an investor looking for? They're looking for a management team that they will be able to invest in. So yes, you've come up with a really interesting, unique proposition, but actually, are you the team that are going to be able to bring that to fruition? Are you the team that are going to be able to adapt to market changes and different environments and competition? And can they invest in you because they believe that you will succeed, even if the ultimate business won't be what you originally envisaged up front?
And as an investor looking at that proposition or that idea that you've described, what do you think are the key questions that might be in the mind of an investor that people need to hit in that elevator pitch in the way that they describe the proposition?
Yeah, it's about what does the market need, really. It's is it an interesting dynamic market? Is it a growing market? Is there an inherent inefficiency within the market? And how does this business uniquely solve that issue or that opportunity? And if you can get those two elements nailed in your 30 seconds or through your script or presentation or whatever it is, the tool that you use to communicate to potential investors. If you can get those two things absolutely nailed, then you're on a sort of on the right trajectory. You absolutely have to talk about, the size of the market, what's addressable for your business, what the competition are, both direct competition and indirect competition, what the leading other players are doing who might be tangential and might end up coming into the space, where a potential exit might be. Lots of things that you'll want to consider and factor in. But actually, that first piece of here's the market need and here's how I'm uniquely positioned to be able to address that market need is the 30-second pitch.
And do you think it helps to have some other data or research or information to give that those ideas context and the market context to back up what's being said about market size and what the business thinks it can do?
Absolutely. With all of these things, investors are looking for as much assurance and as much evidence to de-risk what they're going to be potentially investing in. So to the extent you wouldn't necessarily pitch this in your 30 seconds unless there's a real wonderful data point that you can reference. But in your kind of proposition, having as much evidence-based research in there that demonstrates why there's a market need, why the market is growing, why there is a gap in a particular sector that you're trying to fulfill, what's the size of the competition. If you're doing something that's very similar to 5 competitors in the marketplace, but you're coming at it from a slightly more unique position, what is the size of those companies and how much joy are they having in the marketplace? So any evidence that you can provide to back up your proposition is invaluable to potential investors. They will do their own homework. They will absolutely get to understand that sector really well. If it's anything like some of the early stage PEs and venture capital firms that I've worked with, they will become market experts in the space of a week based on the fact that they're interested in an idea, because they all want to know it inside out before they invest. But you're the one that's going to have to pique their interest to get them excited about that market in the first place. So anything you can provide in terms of data, absolutely, please do.
I once had a conversation with a startup about the idea of describing the other companies that are operating in the space, and they were quite reluctant to do that because it was almost like telling the investors who the alternatives are and who else they could look at. But I said to them, no, you've got to be transparent about that because it shows that you understand the market. The fact there are other companies trying to do it proves there's an opportunity. If there was no one, then you'd wonder whether the opportunity is real or not. But more than anything, as you just said, it's an opportunity to show that the company gets the space that it knows the threats and opportunities and competition. So the more, it's not giving the game away. Being transparent about that is helpful to the business case that you're trying to develop.
Absolutely. To the point I made earlier, it's about de-risking the investment for the investor or potential investor and demonstrating that there are successful companies playing in this space. Absolutely, that de-risks the view for them. As Mark says, you shouldn't ever be shy about saying, here's who my competition is. They will want to know that. And if you don't say that, then you look naive. Because they will establish that in their research as to, okay, wait a second, these are the competitors out there. And if you haven't told them why your proposition is different from what the competition proposition is, they have to fill the gap themselves. And they might come to a conclusion which says, oh, you're just trying to play in exactly the same space as everyone else with the same proposition. Why would I invest in you versus anyone else? So you're absolutely wanting to be front-footed on understanding why you're unique in the marketplace.
So once you've got a feel for the proposition, what the business is trying to do, what the market is, and what those other elements look like, how do you progress from that to beginning to think about a valuation for the business that you're looking at?
So valuations for a startup business are notoriously hard because there's very little track record to go on. And Mark, I'll throw over to you in a second. I'll give my first point of view here. But what investors will ultimately want is a business plan. Now, the one thing that we could all probably say is whatever that business plan is, it won't be the same in a year's time or even 6 months' time, possibly not even 3 months' time, because as you understand the business and your proposition, as you understand the market and the changes that the market will go through over that period of time, your business plan will have to change. But what they want is a business plan. Why do they want a business plan? It does a number of different things. Ultimately, it allows them to value a business. But what does it actually do? It gives them a sense that you have understood your market, understood your proposition, understood your products or services, understood how you're going to roll them out, which clients and customers you might target, how you're going to sequence that over time. So it demonstrates to them that you've done a lot of the thinking around the proposition and the revenue story, and then how you tie that into how you're growing your cost base. They won't want to see you hiring, a full team of 300 people on day one, but they will want to know that you understand that you will need 300 people in order to deliver 10 million pounds, 20 million pounds of revenue at some point in time, if that's where you get to. So that business plan does a whole series of things, even though ultimately it may be a bit of an exercise, but it just demonstrates your knowledge and your confidence in your plan, and it allows you to talk to that, to communicate that confidence with the investor. The investor will ultimately use a version of that plan. They might add a whole series of sensitivities and discounts and do various other things to value your business as a first pass. And then they'll use a lot of other techniques to come up with what they ultimately think they want to value you at. But a business plan is a great first place to start. And the one thing I'll say, and then I'll hand over to Mark, is 20 people can get the same business plan and they will come up with 20 different valuations. And you as a seller or owner of a business will come up with a different value on the back of your business plan than any other investor will. Just be comfortable with the fact that that's going to be the case. Don't think, wait a second, I valued my business at, £1 million up front and somebody's saying it's only worth £200,000. That is to be expected, not necessarily that level of discount, but just the dichotomy in valuations is to be expected. And what you're trying to do is ensure that the investors understand why you have confidence in your plan and the basis of some of the assumptions within it that allows you to have a meaningful conversation about investment. Mark, I've done a lot of talking. I'll throw it over to you.
Yeah, where do I begin? Thanks, Pakar. And look, obviously, I would say I'd agree with everything you've said. I suppose one thing to cover is a couple of things, just building on what Pakar's just said and Mark's just alluded to. So you're not looking at a near-term opportunity or a near-term business plan here. What investors are doing, of course, and I'm probably being a little bit kind of, I guess, preaching to the converted. They're sellers of assets, typically, certainly in the VC and funds world. They are sellers of assets. So if you're like a VC, you're looking at 10 times your money. That's what they want to get out of any early startup scale up. That's the sort of level of return they're looking for, because that's how they make the maths work. And that is quite frightening. I guess how on earth does somebody put in 1 million and pull out 10? But that's the sort of economics they're working to. And that's the generalization, but that's broadly speaking what early stage VC investors are looking for. Obviously, if you've got a trade player, it's totally different. And I think this is why you do get this massive spectrum of valuations. So I'm looking at business. Let's look at some real stories. So I'm looking at a pre-EBITDA business at the moment. It does about 25 million of revenue, loses about 4 a year. It's valued at about 150 million. 70 million up front, 50 as an earnout through put and call options. But fundamentally, the reason that's so important to my client is it fits brilliant with their long-term strategy, and it provides something, just building on what Pakar's just said, it provides something unique and compatible and needed by them. It would take them 10 years to develop this thing. They need it now. It fits in perfectly, and therefore the premium they're willing to pay for control of that is massive. If you're a VC investing on your standalone business, it's a different ballgame, right? You know, they might love you as a management team, they might understand the market opportunity, but building on again what Bakar said, the more granularity you can give around why that business is unique and why you're going to win in your chosen market is going to be absolutely critical. And the more detail and data, sadly, you can prepare, and the more robust and thoughtful a business plan, the more thoughtful the equity story, the more thoughtful it's underpinned by the wider market opportunity, more thoughtful you can present, you've understood the strengths, weaknesses, opportunities, threats, the good old SWOT analysis, the better. Because I think leaning into these things is the way you're going to articulate where the right team, got the right proposition. It might be your own IP. Is it your own IP? And how can you win in a marketplace which may or may not be crowded? So you've got to stand out from the crowd. There is a lot of capital out there. People talk about the concept of dry powder. VCs, private equity, they all want to invest. They've all got capital to deploy. Trade balance sheets are much stronger, I'd say, in the last 5 to 10 years. So there is capital out there, but how do you differentiate yourself from the pack through, you know, all the things that Bakar has just kind of mentioned: quality of the management team, quality of products, understanding the market opportunity, why you're positioned to win, credible business plan, well underpinned by data, you know, and you can position it in a way which kind of is exciting, attractive, and people can, more importantly, can see the long-term opportunity. What is the route to 10x? What is my route to 10x? There's no point having a business which you think will be a fly by night for 1 to 2 to 3 years. How does it fit? And what is the exit? What do you think the exit could be? Is it IPO? Is it you know, sort of more traditional private equity? Can you see it fitting well into a global corporate because it's a proposition you've built which can plug in? And there's many examples of that. And certainly a lot of the corporates we work with are often doing that: the plug and play, the platform play, the buy and build, and so on. So there's a vast number of factors to think about, but you've just got to get a bit of structure around it. Sorry, Pakar, I kind of rambled on a little bit there.
No. I just want to. I agree with all of that, Mark. I just want to pick up on a couple of points you said. The more homework you can do for the investor, the better. And that point that Mark just raised about the exit point, if you can give them visibility of what their exit would look like. For a strategic corporate buyer, they might not be looking at an exit, and so it's a different ballgame. It's about how would this plug into their business in the right way. But for a venture capital firm, what does an exit look like? And if you can demonstrate why that is the right path, again, it may all change, but if you can demonstrate to them up front, it allows them to start thinking in that way, and therefore try to work out whether they can get a 10x benefit on their investment up front. The more homework you can do for them, it just makes their life easier, but it also gives you a huge amount of credibility in the room because you've done all of that thinking for them.
So once you get a business plan from a startup, an early stage company, which maps out the future in beautiful detail, it's all very convincing stuff. But where it is now is at very early stage, maybe pre-revenue or very little revenue. How do you? I can see how I could convince you that in the future it's going to have a great valuation. But how do you reduce that to what the valuation is now? How do you start thinking about a number if the business has got very little money running through it yet? We can see the future, but in terms of where we are now, how do you think about that?
So investors will take they could take lots of different approaches here. There's probably two that I'll talk to. One is the returns analysis, which is the 10x that Mark talked about. What would they put in today, and where can they see the business in 5 years' time if that's their exit horizon? And what do they think the business could be valued at that point based on a sensitized version of your business plan? And if they can come up with a view that says, well, even if you achieved, I don't know, half of the revenue that you're expecting and have a cost base that is 50% larger than you thought it was, actually at that point, with a good trajectory of a business going forward with growth prospects thereafter, I think I could get a valuation or a secondary buyout, private equity takeout of X, and therefore to get my say that is a number, I don't know, I'm going to use round numbers. So if that is 100 million, for me to therefore get my 10 times return, I'm up for putting in up to 10 million today at the right, valuation, and getting the equity level I want. So you can sort of do the math and work that backwards if you want to, and I've done that on occasion. But traditionally, the thing that I would do, and I've invested in a number of startup businesses, is look at their business plan and look at the financials running through 5, 10, possibly even up to 20 years for some of these things, which is a little bit of a misnomer because in 20 years we have no idea what the world's going to look like. But I would look at that and then use discounted cash flow analysis to work out what the value is today, even though it's pre-revenue and pre-profit.
Right.
And so the way that ultimately gets calculated is by understanding the strength of the assumptions behind the business model. And if those assumptions aren't very sort of based in evidence, or I've got question marks as to whether the management team can achieve those, I'm going to just apply a much heavier discount to them than if I've got much more confidence in that management team and being able to deliver those revenues in the time frame that they set out. So discounted cash flows, or a kind of a multiples based approach in terms of sort of entry point, exit point, and what I'm looking to get as a return is are simple ways of doing it. Mark, you've probably seen even more valuation methods than I have. Are there other ones that you think VCs would be looking at?
Well, to be honest, it's a valuation at this stage of a business it is a bit of a dark art, if I'm honest, and it's a combination of emotion, need, and probably, quality of the management team, quite frankly. And I suppose an emotion is a big part of this actually, because people are buying into the team and obviously the business as well. But there is a real kind of emotional back and forth, I think, within businesses of this size and scale, and kind of, excitement, I suppose. The thing we haven't mentioned, it's all very well looking at business plans and valuations, but what we will always do is obviously look at comparables. So we're looking at benchmark companies, we're looking at comparable transactions, we're looking at sector dynamics, we're looking at growth rates. So certainly what we do as a business, and other advisors do too, we'll look at, what is the context of your business and the context of the wider market, and how do those valuations compare? So if you're asking me to put in 20 times year 5 revenue, and I'm looking at similar businesses in a similar sector with similar growth rates, and they were valued at 5 times revenue, well, we might have an interesting emotional conversation. But you've got to, this goes back to just understanding your marketplace and the market you're inhabiting. So really understanding those COCOs, as we call them, comparable companies, comparable transactions. And you might all say, well, there is no comparison. Well, that's different again. You're then into kind of hope value and kind of belief. And then you're back to emotion, which is always super cool. But I think that kind of, the wider market context and how you're positioned in that, looking at multiples, is really important. The other thing to think about is the people you'll be dealing with on the investment side at the front end. They are not the only people you have to convince. So as you guys will probably know, or some of you will know, for every venture capital organization, for every large corporate, for every large cap private equity house, every mid cap private equity house, they all have an investment committee. And they're all kind of competing for capital. So every investment director will be competing for capital from the investment committee. So if that due diligence, if that business plan, if the equity story is really not well underpinned, it makes it much harder for them to kind of, release capital to you versus another. So, and that's why you've got to understand the business as the business, the management team as a management team, the opportunity in year 1 to 3 to 5, and the cash need as it goes through that growth cycle. Contextualizing your business in the context of the market, COCOs, co-trans, and then also kind of having a really well verifiable, robust business plan, cash flow projection, which people can live behind. And it's really interesting. So every deal we talk about deal fever, and some of you on this call may have been through transactions before. Everyone gets excited. For some reason, the lawyers love working all night and signing documents at 4 a.m. And then everybody kind of gets the deal done and they think it's done. And of course, that's where the hard work begins. And I've got friends who've sold businesses, and they go, bloody hell, month 1, the PE guys and the venture capitalists are already asking me why I haven't missed budget. I mean, can't they just chill out a little bit? So, well, no, because they'll be on your case, and it's also important to choose which VC or which corporate because they're all very different too. Some are passive, some are in your face, some are going to be more supportive. So the type of investor is also really important, and that'll influence who you would potentially go with. But that business plan, once you've presented it to investment committee, once that cash has hit the coffers, they'll be on your case month after month after month, either in a supportive way, hopefully, or if your numbers are completely kind of pie in the sky, that becomes more challenging conversation. So the more granularity, the more detail, the more you can defend against downside through scenario planning and so on and so forth, will all help in the end. Again, sorry, that's a long-winded answer, but in terms of valuation, it's such a subjective area. It depends on the buyer, depends on the nature of the buyer, depends on where it fits. It depends on, what their returns thresholds are in the fund. So I suppose what we're saying is you've got to do your homework in terms of who the investor is, why they would look to buy you. So think about, portfolios of VCs at the moment. Where would you fit best? Because those VCs are more likely to understand your business, your need, and they could probably, help you on the next stage of your kind of growth journey.
And there's the adage of the valuation is what a willing buyer is willing to pay a willing seller, right? So whatever it says on the spreadsheet or on a piece of paper, ultimately, if you're not willing to sell at that, it's not being valued. So, it will be a negotiation. To Mark's point, it is an emotional journey because you're selling part of your business, your baby, to somebody else to kind of cast an eye on in such a detailed way, not just during the deal process, but thereafter, hopefully for an extended period of time. So actually, it is a negotiation. It is an emotional journey. But if you do all the things that Mark just mentioned, you're much better equipped at having those conversations than if you haven't.
And just on the topic of belief and emotion, just to give a simple example, I once worked with a music tech startup, which was very, very early stage, not much more than an idea, but a very convincing management team with a great vision for the future. And I said to these guys, well, how much are you going to raise money at? What valuation are you going to go out at? And they said to me, our business is worth 2 million. And I said, well, why do you think it's worth 2 million? Because there was no beautiful business plan the way that you're saying. And they basically said, well, because we say it is. That's what we are going to get. We're raising money from some quite sophisticated angel investors and kind of very early stage, some small venture funds. And they don't really know how to value us because it's difficult to predict. So we're just going to go with this number in a confident way and we'll push for that. Do you think that works?
It can do, and I've probably got an example myself where in ITV I was looking at investing in a company who we actually the management team were already part of the organization. They wanted to spin out and do their own startup, and they came to us and said, we need £3 million. Why? Because that's what their cost base they thought would be over the period of which they can get to cash flow break even. And they said, and that's for 25% of the business. Why? Because we don't want to give you more than 25% of the business. Yeah. There's no rationale behind that. And then that's all we're willing to part with. Yeah. At that point, you're in a situation as an investor of saying, well, is this something that I'm willing to get behind? Because that is the only deal I've got available to me on the table. Yeah. And then, there's things that the investor can do. And in that case, what I did was I said, well, based on my valuation metrics and where I think the comparables are and where I think I can get the organization comfortable, I can give you £1 million for that 25%, but I know you need 3 million. So I'll give the rest to you as a loan that you have to draw down over the course of the subsequent 2 years. Once you hit particular milestones, so I'm not just having 3 million gone out the door that I won't see anything back on, but actually I'm dripping that through as and when you hit your milestones. So it's a way of squaring the circle. But yes, absolutely. You can come up with a brash, if that's the right phrase, view about your business, your capability, your opportunity. And if you get enough investors or an investor really excited about that, And in our case, we couldn't afford to let them go at ITV because if they came up with the next big hit, we would have egg all over our face. So we just could not do the deal. But if an investor is excited enough, then they'll be willing to at least engage in that conversation, even if that isn't quite where they end up.
Yeah. Just before we move on to the next topic, Matt, are there any questions or?
Yeah, thank you, Mark. I've had one question through from Tom Grayson, but I feel Tom, as though maybe the chaps have already answered this question about methodologies for valuing pre-revenue companies. Do you feel as though that's, or is there any other additional bits to that?
Actually, in the chat, yeah.
No, you nailed it. Very interesting,
Very
different
good.
perspectives.
Good to hear, Tom. I've got a raised hand from David. Over to you, David.
Yeah, just a quick one. When you're doing that evaluation, the due diligence, how much value would you put on something like a memorandum of understanding or a letter of intent? And actually, what would be the key? You can have different elements of detail in there. Are there any key bricks that you would want to see in an MOU or an LOI that would help you to value the business?
Mark, do you want to go first? I'll chip in.
Yeah. Thanks for the question, David. Are you, in the context of that letter, what you'd expect to see or what you would not want to see?
I guess what an MOU that just says we're going to work together is one thing, but then there's different layers. We're going to work together, and this is the valuation, and this is how we see it going, and this is the term.
Yeah.
I'm just interested in what would, if I get an MOU, what should I ask for that would make you, Mark, more confident in the valuation and investment?
Yeah, I mean, usually with an MOU or a letter of intent, it's obviously not a binding agreement to actually invest, right? So really, it comes down to conditionality that sits within there. So we see some awful letter of intents which look like a Valentine's card with a load of abuse written on the back. So we really want to get together, but actually turn the page over, and what you've got is, but this is subject to these 15,000 different conditions. So I think for me, and Mark, you'll probably be able to answer this too, because you probably draft these things, but you've got to be really kind of smart around what's actually in there and what it actually means. So sometimes you think you've got a deal done, but it'll be the subject to piece for me is the bit that you've got to really pay attention to, David, because quite often I'm inputting into that. So I'll say to my client, I don't think we can go there yet unless we do the following 5 or 6 steps, and some of those 5 or 6 steps can be quite draconian. It may be there's a tax structure change that needs to change. There may be a major concern about, I don't know, a legal structure that's been set up, which is not particularly great from a tax perspective or exposes my client from a tax perspective. There may be some conditionality to, is it an upfront payment? What's the structure of the deal that you're kind of notionally putting on the table? Or is there some implication that there may be some long-term earn-out with some complex put and call options in place? So I think for me, in a letter of intent, generally it's quite nice. Generally, it kind of tells you what you want to hear, because at that point you're still courting until you get into exclusivity. But for me, what are the conditions attached to the letter of intent, and how are you going to address those? And are they fair and reasonable? I don't know, Mark, you will see these and comment on them all the time, but that's where I would look for the red flags.
Yeah. Sorry, David, did you mean a letter of intent from an investor or from a business partner, from a from
a business partner. So I'm coming to you and I'm saying, look, we're not married yet, but the ring have been the engagement ring is being purchased. I think I said probably.
No, exactly that. Understood. So if I'm advising a company which is looking to raise money from investors and it has an LOI from a potential business partner. So let's say it's a music tech startup that has an LOI from a major label. That's someone showing interest. And to me, in that situation, although I agree with Mark's points about the detail, in some ways it's not so much about the detail, it's about the fact they were willing to sign it at all. The fact that major was willing to engage with that startup and take them seriously enough to go through an internal process and get to a point of signing an LOI, to me, that's a big endorsement of whatever that startup is trying to do. And so if I'm acting for a startup, assessing what they're doing, I'm looking for some kind of proof points or endorsements around the people they're working with, the people they're talking to. And so if they have an LOI from, let's say, a major label, if they've got a really good person as an advisor, if they've got someone in the management team, you're putting together all those different proof points to establish how credible they are. And in that sense, although I agree with what Mark said, in terms of getting a deal done and actually taking that LOI through to a signed deal, those points are important, but might be secondary to the fact that that major was willing to sign it at all, to engage with them at all. Just being there says something about the credibility of what the business is trying to do.
Can I add one point, David, just to the point you specifically raised? I don't think letters of intent, MOUs, term sheets are really driving valuation thinking or assumptions around valuation. They're about documenting the key commercials and the conditions around those key commercials for an investor coming in. So you might be able to read through and say, okay, well, it's this value for this percentage, and they want this in terms of options or whatever it might be, and you might get to a valuation or implied valuation through the journey of that deal, but that is not driving the valuation in itself. It's about documenting how the structure of the deal is going to occur.
Yeah, thank you.
Okay.
That's brilliant. We've just got time for one more question before I think we move on to the next section of content. Dimitri Garin's just asked, perhaps there are typical sizes of investment checks in the music technology space that are written at pre-seed and seed stages in return for a certain percentage, and could this be the basis for evaluation?
Yeah, so in my experience, there are not really typical sizes of check. It all depends on the size of the business and what they're trying to achieve. And in fact, that's the next topic I was going to move on to, actually. So perhaps we just cover that in the conversation now. Once you've got a valuation or something like a valuation range, how do you think the businesses should think about how much they need to raise? How far forward should they look? I've worked with companies that almost try and talk themselves down on the basis that it's easier to raise smaller amounts. That may or may not be true. And other businesses that take a more confident view and say they want to look to raise more to give them more runway further into the future. And there's obviously a balance somewhere in the middle of those two things. How do you think about that? And this would kind of inform the question about check size and so on.
Yeah, I'm happy to go first, and Mark would come in after that. But
Yeah, sure.
so that balance is the key, right? So in one way, you want to raise as much as possible because that will give you as much runway to do as much as you want. There will be a limit to that. You won't ask for an infinite check, but you'll want as much as possible. But especially at an early stage, the larger the ask, the bigger the percentage of the company you're likely to be giving away. Against that, you then have the complexity of, well, if you do I want to go for the smallest amount I can get away with to get me through the next 3 months? Well, then you have to do another fundraise in 3 months' time, whether that's with the same investor or with others. You're going to have to refresh all your documentation and go hunting for cash again. And you don't want to do that too often because that's going to detract you from being able to actually drive the business rather than doing roadshows with potential investors. Is there a kind of a set rule as to how much you should ask for? No. Is there a set time frame you should ask for? No. It's really about what you think you can do, and that balance has to work for you between that security of runway and the amount you're giving away. But my instinct would say, depending on the nature of your business, you want to at least have enough cash to get to revenue, and ideally enough cash to get to cash flow. But you might choose not to do that because actually, by hitting certain milestones in your technological development where you're going to, have IP, register your patents, have a working prototype, whatever it is, at that point in time, you're going to be a much more compelling business to raise capital on. And therefore, actually, I only want to give a small amount of the company away today because actually I can get the rest of the money I need in 6 months' time when I can do it on a much lower valuation. Mark, throwing over to you.
Yeah, I mean, just to add to that, I mean, I'm a Yorkshireman, right? So I come out with pretty simple statements sometimes. And for me, it's what do you actually want it for? What do you want it for? Why? And how much dilution are you willing to accept? That's ultimately what it is. I mean, I think to Pakar's point, what you don't want to be doing in these things is is raising cash and then 6 months later going back cap in hand because you've burnt through it far too quickly. So it goes back to that kind of, real nice cash flow underpin and being really clear on what you're going to use it for and why. I mean, clearly at this stage, any investor wants you guys to have massive skin in the game because ultimately they're backing you. So what does that cash runway look like? Are you clear on your cash burn, on your upside, your downside? Are you satisfied with the level of dilution? So you get it into bed with people you want to be, and you don't feel like you're giving stuff away. So for me, it's about how much, what for, why, is it underpinned, and are you clear it's going to take you through to the sort of metrics that Pakar's just talked about?
And just to add one more point to that, and just again raising what Mark just said, it is about cash, not about P&L. A lot of people will talk about revenue and EBITDA or EBITDA, but ultimately, especially with technology businesses where you're going to be investing a lot in the fundamentals, you're going to be capital investment rather than necessarily just operating investment. It's how quickly you're going to burn through the cash. And therefore, where do you want to get to, and how much are you going to be willing to be diluted, as Mark said?
Yeah. And in terms of, we mentioned milestones where further funding might come in, and I've been in situations where those have worked very well, and people hit the milestone, or the business plan needs to change, and therefore the milestones that were negotiated are no longer right. They don't fit. They might for good reasons, the business might not be able to achieve them, and there might be nothing wrong with that. It might be just taking a different direction. But so I've seen those work for and against founders and businesses. Do you have a feel for a good way to approach milestones to avoid them becoming, a problem in the future? It's quite difficult because of the unpredictability of it, I guess.
So a way to approach milestones without them becoming millstones.
Yeah, exactly.
I mean, there's no easy way to do that. An investor will want you to have milestones because that again gives them a sense of almost checkpoints or points to mark homework where they can establish whether the business is in line with what they thought it was going to be and what they were investing in. For me, it's about finding the investor that will work for you, knowing you're more than likely going to have to evolve your proposition, your technology, your business. So is this an investor that's going to, ride with the punches?
Yeah. Or
is this an investor that is going to, bash you over the head the first time you deviate from the tracks? And certainly ITV, when I was there, for startup companies, was willing to ride with the punches. And I think most VCs will do that, but you've got to get one that you believe that they will do that with you. Because VCs know that the businesses they invest in have to evolve by the very nature of the startup.
Yeah, and it's the same with high net worth individual investors or angels or family offices. It's always worth thinking about. It's great that the person is investing in the round now, but how much capacity do they have? How much interest or just cash do they have to fund the future if and when we need more? And needing more would be a good thing, right? It would mean the business was expanding.
The only other thing I'd say about milestones is be honest as you have problems, because the worst thing you can do to an investor is blindside them and come to them, to use Mark's analogy, cap in hand at the last second and say, I'm going to go bust tomorrow unless you give me more money. And that's just a terrible conversation to have. You won't get the answer you're looking for out of it. Go in, you don't want to tell them, every time the hinge on the door doesn't work anymore, is a squeaky, but at least at the right point in time when you see that your business is not on the track that you thought it was going to be on, going in and having an open conversation with them and getting them to work with you to find solutions to develop the next set of milestones that you both agree to is a really important thing to do.
Yeah. Great. So Matt, we've only got a few minutes left before 2. If there are anything you'd like to say or other questions, I think now is the time.
We've got a raised hand from Adam who's had it up for a while. So over to Adam for the first question, please.
Thanks, Matt. Yeah, I've got a few questions, sorry, but my company won a smart grant, Innovate UK smart grant, which was very competitive, hard to win. I was just wondering is there more likelihood to get investment or more credibility if you receive government money for your idea based on how difficult it is to win a grant?
Maybe I'll start with that. And firstly, congratulations. That's awesome. I mean, for me, anything that endorses what you're doing and the product you have and the proposition you have, and forgive me, I don't know exactly what your business does, but anything which helps underpin and adds credibility is a big plus. So as people are looking through, has it got revenue? Is it not? Is it in control of its cost base? Does it its budgets? Is the property is it its own IP? Can we see a really good market? If you add to that and it's won awards and it's won grants and things like that, as long as that's a grant which is not just thrown away willy-nilly and it's just thrown away like confetti, which many are not, I think it's a great thing. So I think that'd be a tick in the box, I would suggest.
Thank you. Yeah, I feel that in some ways I'm sort of ahead of the game a little bit because obviously the potential market I've had to analyse to get the grant.
Yeah. Because you have to do that, right? To prove that you should have it.
Yeah.
Can I just add one thing there, Adam? And congratulations, and I agree with everything that Mark said. The one small asterisk is the nature of that investment. So if that investment comes with potential conditions, anti-dilution elements, a whole series of things that might have been sort of under the radar for you because you've won this amazing grant. Those elements, the kind of legal T's and C's, may end up making it won't make your business less attractive, but it'll make an investment possibly less attractive.
Yeah, so it's £500,000 just straight. There's no equity in exchange. It's literally just
wonderful.
So it's great.
Yeah, wonderful.
Yeah, pretty great
No
result.
conditionality. There you go.
We got you have to provide 30% of the investment of the cost of the project as well. So I had to raise that. So I had to raise 135. Some of that is done with loan notes. So that's interesting what you guys were talking about with the loan notes earlier. So obviously it's a positive thing, but it's kind of like a social proof, like a credibility. Thing, isn't it? I've got a few other quick questions if you don't mind, if you have time. Is that all right?
We are kind of running out of time. Maybe one more if you can kind of summarize it quickly, and then I just wanted to open up and see if anyone.
Yeah, it's a bit more mundane, but the market research. I noticed when I was trying to get my potential market research done for the grant, a lot of the figures are up with like the competition. They seem to be like behind closed doors. Like you have to pay a large amount of money to get the sales figures of your competition. Would you reckon pay a third party to do the market research, or would you guys agree with that statement? It's actually quite hard to get into the nuts and bolts with the figures of your competition.
I'll start with, I might just answer the last bit and then Pakar, this is your bread and butter, right? So in terms of, there's a whole load of barriers, right, Adam, to sometimes getting your competitor sets data. And if you ever go onto Companies House, which I'm sure is where you starting point, you'll suddenly find there's small companies and exemptions. There may be in a private equity tower, so you can't actually see or find where the actual numbers are reported, so you can reliably say that is the competition's figures. That's how they may have taken investment halfway through. The last 2 or 3 years, they might have changed a year end. So there's a whole load of funnies, which, to be fair, are probably the reasons is if you were growing, you probably do the same thing. You don't want your competition necessarily to see what margins you're making and so on and so forth. So it can become quite difficult, particularly where it's kind of emerging business model, emerging technology, where it's difficult. And then you've got to kind of, well, what is the market you're trying to benchmark against? So you quite often, if you did a bit of co-piloting, you might get a whole load of growth rates for a market. It hallucinates to you. You get behind the numbers and you realize they've included a whole load of stuff you wouldn't necessarily associate with your competitor set. So then you're left with, well, how do I get something credible? And quite often that requires expensive research. It requires, maybe using a third party. But I would say that if you did do that, at least you can define what you want and why. And particularly when you go into some of the more sort of serious fundraising rounds, going back to what we were saying before, having something which is really credible and underpins, because what I found working with VC and private equity, typically in the deal process, they'll end up understanding the market and your company better than you will.
Yeah.
Because they will be spending money on research, they will be spending money on due diligence, they will be and the last thing you want is them to say, well, actually, we don't agree with your addressable market definition.
Yeah.
You say,
that's what I'm worried about.
I've cobbled it together a little bit. I've done my best, and they'll go, well, actually, we've commissioned, I don't know, some whoever
Yeah.
and this is actually your market. So tell me why you're growing at 2% and they're growing at 20.
Yeah.
So you've got to be on the front foot. So unfortunately, that does sometimes mean throwing a bit of cash at it. But I think in the long run, depending on where you are in your fundraising rounds, it's not a bad. It's probably money well spent, provided you get that scope right.
Yeah. That's good advice. Yeah, I think with the grant, with the smart grant application, you get very limited amount of text for your answers. So in a way, that helps you because obviously you can't
Yeah.
you can give them a ballpark. But what I'm worried about is if I'm trying to get the next round,
Yeah,
we need some big money, and I'm going to need to be the credibility's got to be there.
it does. Yeah. Otherwise, someone will pick through it.
Yeah. Okay. Thank you for that. Appreciate it.
We are at time now, so thanks for those questions.